Hello traders, this course is going to be on gap setups. Remember the last time you heard Nifty or Sensex opening 100 points or below the previous day's close? Well, that is a gap. It usually scares people away, but for us, we're going to find opportunity in these setups. Now, these gap setups are for intraday use only. We primarily use the hourly charts. You may experiment with other time frames. Gap trading is always to be used in context of the current trend. And finally, it's to be used in conjunction with a full-fledged method like the Newton method or any other method that you may have. You see, setups by definition happen once in a while. They don't happen all the time. So these gap setups actually supercharge your already regular trading system. Now, since gaps are always used in context of the trend, let's review trend identification really quickly once again. You can find a more detailed explanation in the Intro to Technical Analysis course on tradeacademy.in. Higher swing lows like this chart is what an uptrend is made of. Participants buy on market pullbacks and push markets higher over time. What you need to remember is that higher swing lows create an uptrend. A downtrend is just the opposite. Lower swing highs create a downtrend. So participants are selling on every rally, pushing the markets lower. What you need to remember is that lower swing highs is what creates a downtrend. So not all gaps are tradable. We'll describe 3 setups in this course that you can use in all market phases. That's gap setups for uptrends, gap setups for downtrends, and for the sideways market. Let's begin with the first setup that is based on uptrends. This is the setup. It's very simple. First, we need an uptrend, then a gap up or a gap down. Lastly, the opening bar, since we're trading intraday hourly, the first bar of the day must close bearish, so it must be red. We will short sell as soon as we cross the low of that bar. So you put a sell order and wait for the markets to trigger that short sell order. And that is where the opportunity lies. The market usually falls after that. I'd also like to define what a gap is at this point. A gap is simply when the opening bar is far away from the previous day's close. Okay, so we already know what the setup is. Let's see some real examples. You will notice 3 things in this chart. 1, Axis Bank is in an uptrend. Second, the opening bar is a gap and the bar is red. Now what followed was a swift fall. Same thing in this chart. We got an uptrend, we got a gap, the opening bar of the gap is red, and then we fell. In this chart, it actually happened twice. And lastly here as well. This is the setup. First, we need an uptrend followed by a gap, and then the opening bar of that gap has to be a red bar. That's a bearish bar. This is how we trade the setup. We place a short sell order at the low of the opening bar minus a filter. Now the stop loss will be the opening bar high, and the target is 2R. That's 2 times risk. Let's see those examples again. Here we have a gap up and a red bar. This is an uptrend because of the 2 higher swing lows, obviously. That is the definition of an uptrend. The first trade did not reach 2R, which is our target. The second trade, however, we shorted at 1262 and the stop loss was at 1274.6. So that's the high of the bar. That gives us our risk. The entry point minus the stop loss, in this case, is 12 points. Our target will be 12 points times 2, which is 24, which was achieved here. Same thing here as well. We have an uptrend. The opening bar is red. As soon as that red bar happens, you place a sell short order at the low of the bar with the stop loss at the high. As soon as that got triggered over here, you saw the markets completely plummeted. 21 points would be our risk times 2 over here, and that was achieved. The next trade also got us a decent profit. The opening bar was red, it was a gap up, and the market fell from there. The last chart shows Axis Bank in an uptrend and a gap down. The opening bar is red here too. Now, as soon as this happens, you are to place a sell order at the low of the bar and short sell. This was triggered after about 1 to 3 hours, and our target was also achieved right at the end of the day, somewhere there. You'll also notice the previous day was also a short, but in this case, that trade did not work out. Also, one important point about money management. When you're calculating risk, don't simply subtract the entry point minus the stop loss to get risk. You will have to add overhead costs, just like any other business does. That's your brokerage and transactional costs, slippage, and filter. That will be your real risk, and you need to multiply that by 2 to get your target. Hope this setup was clear. It's simple and very effective. In the next lesson, we will deal with gap setups when in a downtrend. I'll see you then.